Bullish sentiment plunges. For me, that's the big news of the week, though there was plenty happening. This is Tom Aspray with the Viper Report Market Wrap video for February 28th. This long-term chart shows the S&P going back into 2006. Below that in red, we have the reading of the AAII survey. How many people are bullish? This is the question is asked, where do you think stocks will be in the next 6 months? Last week, 19.4% thought they would be higher. You can see this line here is at the 20 level. It's been down at the market bottom here in early 2016, also in 22, and also, during the bear market, end of the bear market really, in 2009. Below this, we have the bullish minus the bearish. It's currently at 41.20. Normally, the extreme reading there is a minus 30. You can see we got there a number of times in 22, and also the lowest value ever has been in 2009. Talk about a crazy market. These are the end of the day numbers for Friday, led by the NASDAQ 100 up 1.62, S&P up 1.59. Only gold was lower. If you switch this to look for the weekly, a much different picture. The industrials and NYSE composite were both higher. All the rest were lower, led by the NDX or QQQ down about 3.4%, and the S&P was down just about 1% for the entire week. And it wasn't a great month either. If we look at the 1 month numbers here, you can see that gold and the utilities were up 3%, 2.1%, and the UNARC composite was also up slightly. Everything else was on the downside. The Russell, as you can see, was down over 5%. Transports didn't do much better, and the high-flying tech stocks were down about 2.6% based on the QQQ. When you see that performance data, you're not surprised to see how much bullish sentiment has reversed since early December when it peaked and the AD lines moved into the corrective mode. As we've discussed many times in the past, the market, when it's in a strong uptrend, needs a reversal in sentiment, in my view, to create good buying opportunities. Conversely, in a bear market, they need a rebound in the sentiment to spot opportunities where you can sell in a bear market. Despite the negative values for the month, like in the Spider Trust, it was down 1.3%. The monthly studies still look strong and positive. You can see this is the S&P 500 AD line. It broke out at the end of 2023. Still strong, still well above its moving average. Similarly for the stocks only on the NYSE, it made a new high at the end of the year. It's still in a positive trend after its breakout, and as is the NYSE All AD line. All those look pretty strong. If you go back to the 2007 top, the monthly AD numbers were negative as the market made its high. If we look at the updated weekly chart, we put this out, we're trading around 600 in the SPY. We're thinking, okay, 586.33 was a potential downside target. Then you can see we actually got down to 582.44 last week, dropping below the 20-week EMA, but then closing back above it. Volume was heavy. A further decline could have taken you to 575. That's looking a little less likely. Actually, the AD lines, the S&P 500, let's take a closer look. Though the S&P AD line is still below the high we had in November and not confirmed the new high in the SPX or the SPY, it turned higher last week, which is a very good sign. See, stocks only is just barely below its MA, roughly like 50 issues. And then the NYSE All, it's also still positive. So out of the 6 AD lines I follow, only the stocks only and the Russell 2000 are currently negative. If you drill down to the daily charts, the action looks much more dramatic. We had a high up here just a week and a half ago, and we can see the selling was pretty heavy. We got right back down into the October high in that 585 area, dropped below it briefly on Friday, and then closed up 1.6% for the day on expanding volume. So the volume was moderately high during the early part of the decline, but not up to the levels we saw on Friday. So the S&P AD line, had dropped one day below its moving average, reversed back to the upside, and is slightly above this peak. That's a good sign. Not so much for the stocks only. To turn me firmly bullish, I'd like to see the stocks only AD line get above its last swing high, because right now it's still in a downtrend, and for the all also get above the mid-February high. But it also closed a number of ticks above its EMA here and appears to have held the support at line F. The buying was quite strong on Friday. As you can see, over 74% of the S&P stocks were higher. 20-day EMA, is still quite a ways below. It's at 60.14, and we closed at 59.54. So, we got about 60 points before we move back above it. Also, the 20-day EMA is declining slightly. So, I don't think we're necessarily going to see a significant drop to new lows due to what we're seeing in the sentiment, but we could get some consolidation early in the week. S&P 1500, 58.7% were higher, and in the NASDAQ 100, 70% were higher. Also strong signs. We've gotten moderately oversold here. You can look at what happened, in the early January rally. We had a nice liftoff that wasn't, as strong, in the SPY as this current one, and in the Qs was about the same. So that's kind of what we're looking for now. Of course, you need to take out, this big trading range to give you much higher targets. With all the economic news, you might think that's unlikely, but you can't always draw a rational connection between what the stock market does and what the government or politicians do. There are still some worrisome signs about the market. One is the new high, new low analysis. You can see for the NYSE composite, the number of stocks making new highs is still in a downtrend. We need to see a move above the peaks from early in the year to suggest a change in that trend, and that negative trend for stocks is supported by this upward sloping trend in a number of NYSE stocks making new lows. So we'll be watching these numbers to see if this behavior reverses in the week ahead. The analysis of the NASDAQ composite does look even more negative. Sharp move to 410 in the number of new lows. You can see that's well above anything going back to early August of 2024. Number of new highs has stayed quite low at 71. So it's got a barrier here of about 240 and then just over 300. That we'd like to see a move above that. From a price perspective, the NASDAQ has fallen enough. This nice chart from my colleague Jerry A. shows that the NASDAQ composite did fill the gap way back here and dropped below its Stark band on a weekly basis last week before turning higher. So also important that the prior high, so that was a resistance level. Once we moved above it, it became a support level, and we dropped down to that support level before rebounding on Friday. So that's all consistent with the view that the majority of the selling is over. Now you just need some more positive action on the upside to confirm that. We've been looking at and recommending the QQEW. That's the equal weighted NASDAQ 100. Got hit pretty good last week. Also dropped below the Stark band and below the monthly pivot, but then managed a nice rebound also on Friday. So we're still in this on the long side, though our new longs in the QQQ were stopped out because the decline was most severe in the QQQ. AD line, still looks really strong. Made a new high in February, pulled back, closed back above its moving average on Friday, suggesting that, the worst of the selling may be over. We need to see the moving average start to rise to support that view. The weekly chart of the Qs shows a similar formation. We dropped back below the 20-week moving average, which is now at 512.14. We closed at 508.17, so we could get back above that next week, and held above the yearly pivot. Okay, that's an important level. And AAD line has turned down, but it still made a convincing new high. So it shows no signs of a major top. The RS has dropped below its moving average. So that suggests that for right now, it's underperforming the SPY. But it would not take a lot to flip this around again. In my latest contribution to Forbes.com, I talked about the importance of the yearly pivots and how they can be a nice longer-term level of support or resistance since they're based on the prior year's price activity. Only change every year, and if you look at some of the charts of that, they're pretty impressive. For example, during COVID, you had this dramatic, this is before the COVID plunge here. We dropped below the pivot. And then, 3 weeks later, we're down to the S2, which held very closely. And then by, June, we were back above the yearly pivot, which was a positive sign. You look at the actual numbers down here, so the S1 was at 267.17 for the SPY, and the low was 216. The S2 was at 212, came pretty close to that low of 216. My simple rules for using the yearly pivots are if you have a weekly close above it, that's a positive sign until you close back below it on a weekly basis. And you can see this is one of my favorite ETFs for some time. Flipped back to positive here in early 2020, and moved up. Peaked out here in 2021, fell below the yearly pivot. So for 21, it stayed above the yearly pivot all year. 2022, it closed below it, so you're out. And then until you go back into early 23, we had a whipsaw here, and then a stronger close. And I featured it as one of the Teflon sectors. Still looks really strong. So 90.38, is the yearly pivot for all of 2025. So this table gives you where we closed the end of February, what the yearly pivots are, and what the current quarterly pivot is. Of course, we'll get new quarterly pivots at the end of March, so you can use those as a barometer. You can see technology closed below its quarterly pivot. That doesn't happen very often, as did consumer discretionary, XLY. QQQ also closed slightly below its quarterly pivot. That could reverse easily in the week ahead, while the Russell, it's below both the yearly pivot and the quarterly pivot, as it's been hit pretty hard. I've written quite a bit about pivots over the years, and stock charts makes them quite easy. This is a weekly chart, so if you have a weekly or monthly chart in stock charts and you add pivots to it, you'll get the yearly pivots. If you add a daily chart, you'll get the monthly pivots, and if you have an intraday chart, you get the weekly pivots. So lots of stuff you can study. You can take it back in history and prove for yourself how valuable it can be. Of course, not everything was lower last week. Vanguard Health had a strong close into in January. We looked for a pullback where we bought established longs for both traders and investors. We get above this 274.19 level. That should confirm a move to 281 first of all, and then 286.92, which was the high from the middle of last year. A quick look at some of the watch lists, though they're not completed at this time. Market gauge, 51% of the ETFs were above their quarterly pivots. And you can see that in the growth, that number was lower, 40%, with only, 10% positive weekly DTS. Value was doing a little bit better, 90%, above the quarterly pivot, and 63.6% were positive. And of course, you can see the leveraged ETFs still favor the short side. We have weekly DTS in most of them. Conversely, the long leveraged ETFs are all in the negative mode. None are above their quarterly pivots or with weekly DTS or with daily DTS. From the themes report, you can see some of the medical-related stocks, which are part of some of the healthcare indices, are doing pretty well. Future Med Gauge, 62.5, Genomics, 57.1, Neuroscience at 60. Utilities also look pretty good. Electric, 88.9, that's one of the strongest readings. Ground transportation, 20%, not very good. Air transport at 40, both below 50, as is the retail gauge, which is at 33.3. Hotel and leisure, 50%, so it's right on the cusp there. Infrastructure is doing well, up 77.8. Despite all the hostilities on a global basis, the aerospace and defense is quite negative at 25%. Oil and gas has been all over the place. It's at 50%. You can see XOM, gave a weekly and a 3-day DTS late last week, as did CVX, and PSX gave you a daily after its weekly and 3-day were positive. For the Qs, the biggest NASDAQ stocks, there's not much. Meta and Apple are the only ones, and you can see Apple closed back below its quarterly pivot last week, so nothing to, really a lot of red there. Of course, that's a sign that it's pretty oversold. 25% are positive, so it is set up for a rally. And then if you finish out looking at the Dow, McDonald's, Amgen are the two strongest. They're pretty much green across the board. And, Goldman Sachs is a weekly positive, but not daily or 3-day. United Healthcare, of course, had a tough time. 4-hour, you did see some rebounds here. These 4-hour numbers reflect some of the action we saw on Friday, but still need some work to do, turn the daily as well as the 3-day positive. Of course, the economic data last week was not inspiring to investors, but you've got to remember, you look at the trend, particularly worrisome was the fact that the University of Michigan consumer sentiment dropped a week ago Friday, and then the consumer confidence, people were expecting to be 102, down to 98.3. Also, expectations or thoughts on inflation were not reassuring. New home sales, were a bit lower than expected. And then, of course, we get into the durable goods. It was actually quite strong. The GDP came in right as expected. pending home sales were weaker than expected. And of course, the PCE report on Friday showed no spurt of inflation, so that was a good sign. And overall, and wages were up, so that was also a plus. And next major reading will be the CPI report in March. That's pretty much all I have today. If you go to the Viper report, you can see there's the technical secrets of stock market sentiment. Takes you back through what happened historically, what you can expect, and a bunch of other new releases that might, pique your interest. Advice on how to buy the dip. Some of the declines we had, recently have held to those suggested levels quite well. And also, if you want to subscribe to either the ETF or the Hot Stocks report, or would like some one-on-one coaching, you can find the links there on the Viper report. Well, I can't promise you that next week is going to be any less volatile than the past week, but keep your eye on the data, not the news. Thank you very much.